5% GDP, you add that together with 321,000 jobs created in the month of November. Do you think Janet Yellen starts to get a little less patient? Do you think she's starting to think about changing the time of liftoff?
Yeah, I think that they're going to hike rates in the middle of next year. And remember, what they need most of all, what we all need, is broad-based inclusive growth. Because if they get that, then they can normalize monetary policy gradually while minimizing the risk of a policy mistake or market accident. So they're going to look at this as further confirmation that growth is widening and broadening, and it will make them feel better about gradually hiking rates starting in the middle of next year.
How do you think the markets are going to react to that, Mohamed? I mean, aren't they going to be almost reassured by a sort of back to normal, healthy raising of rates in a regular way?
Yes, provided three things happen. First, the rest of the world doesn't completely fall apart because we're not an island, so we get impacted. So it's important for the rest of the world not to completely fall apart. That's the first thing. Second, that U.S. growth continues to be both robust and widespread. And then third, something you've just talked about. We've had 51 record highs on the S&P. That's one a week on average. And that's despite a 9% correction in September, October. What's that telling you? That there's a lot of cash on the sideline, especially corporate cash, coming in to support the market through either dividend increases or share buybacks. So it's important that that cash continue to come in. If we get these three things, then you can normalize monetary policy without giving up anything on stocks. If we don't, then there will be some trade-off.
Okay, so Mohamed, you just said that the U.S. clearly not an island. I want to talk about Europe because January 22nd seems to be the deadline that Draghi has for him to garner support to form a coalition about, quantitative easing. What do you think is going to happen out of that meeting, and where do we go from there?
So I think he gets it. I think that they will do something on QE. They will look to expand their balance sheet, aiming at that €1 trillion mark. However, it's not going to impact the real economy to any great extent. The problems they have cannot be addressed by monetary policy. They need to be addressed by other things. So the most they can do is buy time, minimize the risk of a big disinflation, but they cannot deliver economic growth on their own. They cannot deliver jobs on their own. They need the help of other policy-making entities.
But it seems like the answer when we ask policymakers and your peers about what happens on the structural side of things, no one has a clear answer, right? The answer you just responded to with sense to Europe seems to be the case that there needs to be more structural reform. You can also apply that to Japan also, where that third arrow from Abe has yet to be pulled as well. What time frame do you have for when we actually see meaningful reforms on the structural component for Europe, for Japan?
So you're absolutely right. And for the U.S. as well, right? I mean, if you look at the advanced countries, there's a reason why they're not bouncing back. One is that they invested too little in structural reforms and too much in the financial sector as the engine of growth. Well, the financial sector cannot be the engine of growth. It has to be pro-growth structural reforms. Second, demand is out of whack. Where there's the will to spend, there's no wallet, and where there's the wallet to spend, there's no will. So you've got to get that right. And third, there's still too much debt in certain sectors. Now, add on top of that, in Europe, you need to get better fiscal integration, better political integration, and you need to complete the banking union. And you see why it is that the ECB cannot deliver growth. The ECB cannot do these four things. So that's why the ECB can buy time, but on its own, it's not the solution.
Mohamed, we're running out of time, but I want to ask you one last question about the American consumer. It seems like everything is sort of coming up roses. We have cheap gas, we have more jobs, we have more confidence. When are Americans going to start getting some raises? When are we going to see wage inflation?
So that was one of the encouraging elements of the November employment report, is that wages are starting to move up. And I think you're going to see that. You're going to see healthy wage growth finally next year, and that's just going to reinforce the tax cut that comes from low oil prices. As I say, the risks to the U.S. economy are not internal. They have to do with what's happening in the rest of the world, and they have to do with non-economic issues. But if the U.S. economy were left to its own, it would continue to gain strength.